Good day to everybody. I'm just being very careful saying whether it's good morning, good afternoon, depending where you are calling in from today. And thank you very much indeed for joining us. We'll be starting in about 2 minutes from now, hopefully, all being well. But again, I thank you very much indeed for joining us ahead of time. That's very organised of you. Thank you so much. And then we'll have I'm Stuart Stobie, you're hearing, and I'm the chair today. And then I will, when we start, I will introduce you to the presenters. We're quickly being joined by a large number of attendees. We're expecting quite a large global audience today. So again, thanks for everybody. If you are listening in right now, you are muted, but you can ask questions, type questions throughout the webinar, where I will attempt to put those to the panel if it's relevant to what we're talking about at the time. If not, I will hold them over to the end, and we'll try and address them then. Obviously, we'll be limited on time, maybe, so we will then answer you by email, and hopefully then you can create a correspondence with the relevant person who will be answering you.
Andy, I've just noticed in the Independent that they're calling for a one-off wealth tax. I don't think that will be welcome, do you?
Well, well, I don't think it will be welcome, but it seems somewhat late based on the report that came out from, I think it's a Wealth Tax Commission. I think they're self-established, self-appointed Wealth Commission. They produced a report last year, which was I think they were very careful, weren't they, whether they were actually recommending a wealth tax or not. But they put some figures forward that if basically any person who had assets above £500,000, and that included things like main residences and business interests, then you essentially paid a levy, which I think was 1% a year over 5 years or something like that, which rather unsurprisingly came to a rather large amount of tax, and that kind of got a few people salivating. But I think if you're saying that somebody is wealthy because they have assets of 500 grand, and that includes their main residence and their pension, don't forget their pension, that to me just sounds like absolute nonsense. And bear in mind, we've got a Chancellor who's an extremely wealthy individual. He might not be necessarily so keen to vote for Christmas. So yeah, I'm not so sure about it. I think there are probably other ways that the government will look to, but it's all speculation. In fact, today's all about speculation as well, isn't it? But there we are.
Thanks to our vaccinations, the pound has increased in value, I've told as well. Anyway, Stuart.
I've just got one question here already from Annette Houlihan. Is everybody? I'm just going to ask my technical people. Is that everybody should be have sound?
Yes, I think perhaps it was just her system, so hopefully she'll come back on and be able to hear.
Okay, good.
Maybe computer audio, I think.
Right. Okay. As I don't want to delay any further, so I will proceed with introducing this webinar. and as yet more people join, and then by the time a few more people join, we're probably into the meat of the webinar. Again, thank you very much indeed for attending this webinar today, wherever you are in the world. I hope all is well with you. We are, as you can see from the title, we're going to be reviewing the proposed changes to the UK capital gains tax, which was promulgated in a report at the back end of next year. But before before we get into the core of it, let me introduce you to the panel, and those presenters are Mr. Andy Wood, who is you see from ETC Tax, which he founded and obviously is on the board of. As you can see from his bio here, that he's a very experienced tax advisor. I've known Andy personally for a number of years, and he is, I have to say, very, very good at his job and in providing advice, and which is a
I think that's
what you want to hear. That is a yes. Sorry, I try not to be sarcastic there. And he's actually and anything he was called to the bar in 2019 as a barrister. So that's Andy Word. And then from Berman's we have John Davidge, who heads up their corporate team. And again, John, I've known for a number of years. As you can see from his bio, he specialises in transactional and corporate finance work, which is obviously very relevant to the subject matter we're reviewing today. And then I have my colleague Simon Denter, who I've known for even longer. Simon is currently has been for a number of years the managing director of Sovereign UK, based in London, though has been with Sovereign pretty much from its inception, opening up its office in Gibraltar. In terms of the subject matter, as you will know, this is all about the proposed changes to capital gains tax and how they might impact, and how you also you may well want to plan. And we will suggest planning, even if there aren't any changes on the horizon. It's always a good idea to plan when it comes to things like capital gains tax, or any tax for that matter. But in terms of the origins of this of the proposals, they came from the Office for Tax Simplification was tasked by the Chancellor to review the CGT regime, and they came back, the OTS came back with a report at the back end of last year, and were looking sort of three key areas they came back with, and that was looking at an increase in rates and the scope of the tax. There was also the impact on IHT due to proposed removal of CGT release upon death, and potentially removal of business asset release. So I think the first question I'll put to Andy, and very straightforward question, Andy. Do we think that there will be a CGT rise coming soon or later?
Well, I think that's the $64 million question, or perhaps more accurately, the £300 billion question, if we're thinking about the deficit. And I think we have to accept that there is a strong possibility that there are going to be tax rises over the horizon, but I suppose when and precisely what taxes is a matter for speculation. I think the potential for CGT has kind of got the rumour mill running in overdrive, really. And I think that comes down to the disparity that we see between the top rates of capital gains tax, which is 20 or 28% for some assets, and a top rate of income tax of 45%. And I think you're absolutely right, Stu, when you flag up the Office for Tax Simplification. review, or as I prefer to call them, the Office for Tax Maximisation, because its report last week was, really, I suppose, a document which really was setting out tax rises, but disguised as simplification. So along with the aligning of the rates and cutting of annual exemptions and removing the rebasing for capital gains tax purposes on death, we've already seen, I suppose, the dialing back of entrepreneurs' relief in the budget last year. So it was cut to within an inch of its life. So it's now 1 million rather than the 10 million before. So I don't think it's surprising, really, against that backdrop, that we have clients, exploring options. And I don't think any of us want to scare clients into action, but there is the risk there, but they are subjective calls, and really, I suppose, we don't know whether we'll be right or wrong until it's too late. Often the case with tax. And I'll put something else out there, that perhaps the rumours themselves, so the leaks, the rumour mill, will they generate additional tax receipts in itself? Because people, talking heads like us, we start pontificating over tax rises, and if that causes people to accelerate tax charges through selling assets, then that does generate additional tax rates without changing, tax revenues without changing the rates at all.
Yeah.
But I totally agree. I mean, I think the point to me, again, as I made at the beginning of this presentation, was that that all taxes need to be looked at, all taxes need to be planned for, and I think as Andy points out, it's not inevitable, but there's been a correspondence and articles and commentary about it that is definitely worthwhile looking at. I think I think while we're on the subject of changes to tax, should we be looking at other methods, Andy, that the government could look at in terms of raising tax?
Well, obviously, so in the preamble, Simon mentioned the article in the Independent about the wealth tax, and that's one option. But for the reasons we discussed, that to me doesn't feel like a likely option. And I think in many ways, capital gains tax rises CGT isn't a heavy lifter, so unless there is a significant change, it doesn't feel like that's going to raise an awful lot of cash. And I suppose if you were looking to raise significant tax revenues, you would, the easy option or the obvious option would be to go and look at income tax and NIC. That's the real sort of bulwark in respect of tax revenues. But the government has some issues there. It's boxed itself into a bit of a corner in terms of its tax lock, and kind of promised that there won't be any income tax rises. Now, I think the grown-up thing for the government to say would be, we did promise that, but the world's changed a little bit since the last election. But sort of grown-up sort of decisions and discourse left, I suppose, with the Parliament and Westminster a long time ago. Other options, I suppose, a corporation tax, but to me, a few percentage points on CT rates doesn't seem like it would touch the sides of the deficit either. And I suppose talked about the wealth tax. The other kind of, I suppose, a bit left field idea which has come up recently, I noticed John Cordwell of Phones for You fame, he was kind of talking about a windfall or an excess profits tax to try and sort of, I suppose, tax some of those companies which have been accused of profiteering in the pandemic. Now, I think for reasons I won't go into, that might be a little bit of a stretch, and we might see a much more sort of reduced, diluted version of that in the form of an online sales tax. But yeah, they're kind of the options, I suppose, Stu.
Thank you, Andy. I think what we'll do now, we'll sort of basically look at various ways that capital gains tax may impact, but also in terms we'll move on to some ideas about what you should do to plan for when you're triggering any capital gains. And we'll touch on, first of all, and I'll put this question to John. So John, if I'm a business owner looking to sell my business to a third party, in other words, triggering a CGT charge, basically, what should I be thinking of in that situation?
Just to warn you, my connection seems to be a little shaky at the moment, so if I'm cut off, I'll try and get back as soon as possible, just to pre-warn you. But yeah, I mean, there's a few simple things you can do in a private limited company, and there's two reasons to do it. Firstly, it's good corporate governance, and secondly, you can look at it in preparing for any sale and crystallizing of your tax charges. The first easy one to do is
Seem to have lost John.
Can you take this up, Andy?
I'll turn myself off mute, shall I first? Yeah, I mean, I think yeah, the question is really about, I suppose, selling to third parties, isn't it? And is that a way that we can trigger a gain for capital gains tax purposes? I suppose the answer there is a definite yes. Clearly, selling to a third party will trigger a gain potentially, assuming that you structure the consideration in the correct manner. Generally, that's going to be structuring it upfront as a cash consideration, rather than perhaps the slightly more sort of paper style deals or the earn-out type deals. Is John back at all? Have we lost Stu as well now?
No, carry on, Andy.
Yeah. So again, essentially, if we're taking the consideration up front as cash, and this is, as I say, something you would expect if the vendor was looking to trigger gains, you want to structure that as an identifiable cash amount up front. And it might be the case that you take that cash over a number of years. So I don't know, let's say, we've got £1 million consideration structured as cash, but it's paid over 3 years. Then even the fact that the cash is deferred, the CGT charge will be triggered immediately. And let's say when we exchange on the contract today, it's the 16th of February, if I remember correctly, then that tax is going to be due by the 31st of January 2022. So what we need to think about here is that clearly, for tax purposes, we want to trigger that gain before the budget, if possible. And I think, generally speaking, it's probably unlikely unless you're a long way along the road of selling to a third party. But if we do that, we've triggered the CGT liability, and we think, yeah, we're great from a tax point of view. But clearly, you're going to have to find the cash to pay your tax liability come January 2022. So that's one of those a very obvious real-world implication of triggering your gain now. Clearly, if one doesn't want to pay the tax now on the deal before the budget, then you would perhaps structure that as paper rather than cash. So you take your consideration in the form of shares or loan notes, and that essentially allows us to take advantage of the no disposal fiction and defer their capital gain. But again, as I said before, that's perhaps contrary to today's objectives. I think, sorry, I'm kind of filling a little bit here for time, but one of the things that that clients do ask me is, yep, fine, trigger the gain before the budget, want to lock in the rates for capital gains tax purposes, maybe want to lock in things like entrepreneurs relief, but I don't really want to pay the tax up front. So I suppose really there we're into sort of cake and eat it territory, and I think we have to be slightly careful there, because when we were in a similar position prior to last year's budget, and I'm sure people may remember that there were very strong rumours that entrepreneurs relief would be filleted, as indeed it was, that the people were kind of going through the same thought process as they are now. Can we trigger again? Can we lock in entrepreneurs relief as it is at the moment? And there were kind of two main ways that people tried to do that. One was essentially taking your consideration as paper, but it's possible to elect for that no disposal fiction to have that disapplied. So essentially you're creating a gain now rather than deferring it as you normally would with paper. The thing is, that election to disapply, you don't have to make it immediately. So a sharp-witted fellow might come along and they might say, well, you know what, let's do the share for share. I'll take my consideration in shares or loan notes. I'll wait and see. If rates go up, then I can draft the election, I can submit it, and I've accelerated the tax charge. Well, when the Finance Act, Finance Act 2020 was drafted, rules were introduced which prevented that strategy, where you were transferring the shares to a company where control was substantially the same. So I think we can expect the same again. So I suspect that strategy wouldn't work ahead of the budget anyway.
Right, Andy, shall we just move into the options now, the structures, the options? Jess, if you can move down one slide, if you've got control, if you don't mind. We're looking at, to some extent, the elephant in the room. We've got 218 people and counting now, and I think people want to sort of evaluate the safer options, certainly not schemy options, certainly nothing something that is procuring an artificial tax advantage, because then you get into the realms of GAR, DOTAS, and disclosure of tax avoidance schemes, and the measures that obviously HMRC Treasury want you to avoid at all costs. But looking at the elephant in the room, your options, because of this impending budget, just a couple of weeks away, Andy, you and I have got to field, I'll field the practical, you start off with the objectives of these practical options, Andy.
Yeah, well, I think first and foremost, it's worth saying that, what the budget, it's the 3rd of March. So I think what I've just spoken about were sales to third parties, and for me, I think it's going to be, well, it's a tall order, isn't it? And that's saying something to get any deal over the line before budget. So I think you're absolutely. I think we kind of now, Simon, in the realms of looking at what can we do in terms of triggering gains maybe amongst family members, or maybe to friendly structures, and essentially looking at gifting or selling to those family structures. Now, I think these type of strategies, and again, you probably still need a fair wind behind you, but they're probably achievable still. in the time we have, depending on what you look at and depending on whether you get all your ducks in a row.
Right.
So I think
on that, Andy, if I think Jess is coming back on with the screen, we talked about rearranging the share ownership of your UK company, and we constantly debate the application of family investment companies, for example, UK family investment companies and even overseas family investment companies. I'll bring those two up. We tend to create family investment companies in the UK to own underlying companies. There may be an opportunity to create a family investment company for a brand new investment range of assets, new family investment companies to receive cash to make investments, and also to existing UK companies, as opposed to having the shareholders being registered individual persons. A UK new family investment company could acquire the existing entity in it, and you have a share swap, so the family members could take ownership in the new company. The new company acquires the UK company. Dividend shares are perhaps held by a spouse member of family. Voting share capital is held by perhaps the founders, and the future growth of shares can be decanted to loved ones, sons, daughters, even underage children, which provides room not just for capital gains tax planning, but for longer term inheritance tax planning, and occasionally be setting up overseas family investment companies, especially if assets are going to be acquired in the EU. A family investment company in Cyprus, Malta, needing to perhaps own immovable property. So the application of family investment companies for pre-existing arrangements, especially brand new arrangements, is an area of Sovereign's expertise, which we do rather well. It's soft. We're not transferring assets abroad. We're not undertaking any aggressive tax avoidance measure, and it's something that is highly relevant in the state of income and certainly capital gains tax increasing. John's back online. Compliments to this, John. We're actually down a slide now, if Jess can steer us down to the impending budget, your options, elephant in the room. Thank you. And it's the options, John. We've talked about moving share capital into new companies, the family investment company. What else do you have to say about that? I think you're hearing us now. You're on mute, John. Mute.
Yeah, okay. I mean, where family investment companies are usually used are in a post-sale situation. So you've got the owner-manager that has sold the business and a substantial wealth, and it is a very efficient way of tax planning for the family. And it's a relatively simple legal structure to set up. It's a set of what we call bespoke articles of association, which most should be familiar with if they run owner-managed businesses. And what this does is it creates a set of what we call alphabet shares, and the parents will receive the A shares, which in effect administer the family investment company, and they tend not to have any right to capital, but only dividends. And then you tend to either do one of two things. You can put the capital appreciation shares into a family trust, which then takes out that capital from inheritance tax, and then give the grandchildren or the children dividend only shares. So you can if the family investment company owns share portfolios or properties or a whole variety of assets, when that income comes into the company, then the parents who own the administration shares can vote those dividends onto the grandchildren and wider family. But it's a very effective way to transfer debt down to the family, because shares in the company are easily transferable, whereas if you, for instance, if you bought a property, a valuable commercial property, it's very difficult to split a property up between children.
where it's very easy to split shares up in a limited company that owns the property.
And I've also used overseas companies to acquire residential and commercial property overseas, especially if you're doing business in the EU. Quite often it's important to set up an EU entity rather than just rely on a UK entity, but you can still have the same share structure. The A shares being perhaps the voting shares with no rights to dividends or capital. You have the dividend shares with no rights to capital and no rights to vote. And then the younger generation can have the capital shares with the value of those shares held for the younger ones. However, what is rather relevant, especially slightly people that like to enjoy power and control, not necessarily give everything away to an overseas trustee, for example, is that on a family investment company, the head of family or the founders can still enjoy board of management, be appointed as a director, and therefore have absolute day-to-day control, as you would expect the founder to transact his own business. So, Andy, other options. We've talked about family investment companies. We probably move on to pensions in a minute. International and UK pensions. Please continue.
One family investment companies, and I think more widely, I think just wouldn't. Sorry, sound like the doom monger, but just one thing to be careful with. I think it's particularly sensitive where we're transferring the shares to, say, in this case, a family investment company, and we're leaving the consideration outstanding on a loan account is some anti-avoidance provisions called the transaction securities legislation, and where you have distributable reserves in the company which you're transferring the shares in, and HMRC thinks you're ostensibly entering into the transactions to turn that potential dividend, that distribution, which would be subject to income tax, into a capital return, then you may have problems with those anti-avoidance rules, and essentially the return would be taxed or subject to income tax. So that's just a word of caution more generally when you're going down that route. I think my own sort of the way I would perhaps look at this as a more general exercise, and I'm quite a simple man, as Stu will testify. I'm very simple. Is that I would probably start from the base that actually, can we achieve what we want to do simply by giving the shares to a family member? For instance, it's easy peasy. There aren't too many tax problems in doing that, and the gift, as long as it's not to a spouse or to a civil partner, is going to trigger the gain and is going to result in a rebasing for capital gains tax purposes. I think for practical, personal and commercial objectives, you need to be happy with that. That you might have an adult child, but a child nonetheless owning the shares in the company. And I think there are some other things from the OTS report on CGT. They talk about what we have at the moment. If you die owning shares, then you get the automatic uplift on death for capital gains tax purposes. So the beneficiary gets them at market value, essentially. And although it's it's perhaps the thinnest of silver linings on death, that you don't worry, you're dead, but you've washed out your capital gains. I think that the OTS review does make some serious noises about removing that. So it makes holding on to these assets for a long period of time less attractive if they remove that rebasing. For inheritance tax purposes, it's likely to be a potential exempt transfer, but let's assume that you're going to get inheritance tax, business property relief on the transfer of the shares. I suppose one step on from a simple gift is a gift to a trust established by the client, so a settle or interest trust, I think if you're speaking technically. And again, you'll end up with a similar scenario where you'll trigger the gain and you get the rebasing. Inheritance tax, generally speaking, if you're over the nil rate band and you're sticking assets into a trust, there is an immediate IHT charge. Again, that should be franked by business property relief on that transfer.
And business property.
Sorry, I do apologise. It's the chair has returned. Unfortunately, my bit of an IT dive, and but on the plus side, there's no camera now available on where I'm sitting, so you don't have to look at my face. But moving on from the from other suggestions that obviously where there's gifts involved, the other people have suggested maybe gifting into trust. I don't know if I've while I was changing my technology, whether we've touched on potentially gifting to QNAPs. Simon, is that something you would consider?
Highly timely, and great to have you back. Yes, QNAPs has had an acceleration of use in recent years. QNAPs, ladies and gentlemen, qualifying non-UK pension schemes. QNAPs, we tend to establish them in Guernsey and Malta, although I particularly favour Guernsey. It has the ability, Guernsey QNAPs has the ability to invest in real estate, invest in commercial property, and different assets, and less constricted than a Maltese QNAPs. Parliament again legislated for the correct use of QNAPs in 2010. It's actually, a QNAPs is not tested against the annual allowance and the lifetime allowance. So if your personal pensions or the SASs, the small self-administered schemes, are getting close to the maximums, and the maximums are probably going to come down anyway, to be announced by the Chancellor, as has been the case in previous years. Transferring assets into QNAPs and using QNAPs to own a range of different assets, companies, properties, commercial assets, alternative asset classes, they are incredibly flexible. And again, Parliament has legislated positively for them. They're not expensive to administer. They're not aggressive. The founder would normally be the person that is transferring assets into the QNAPs. The trustee, like any pension scheme, like a SIP, would be a regulated trust company like Sovereign, that would charge very modest fixed fees. The member would be, again, the founder or the settlor, and the beneficiaries would be the loved ones. And as long as the QNAPs is administered rather like a pension scheme or any other UK pension scheme, and always will have the hallmarks of a pension, serious capital gains tax planning can be enjoyed. And the worst tax on the planet is UK inheritance tax. And QNAPs do actually provide major UK IHT relief, planning, estate planning, and succession. So there is a big future for QNAPs, mostly because Parliament legislated positively for it in 2010. And it doesn't just apply to those non-residents, it applies to UK domiciled persons, deemed UK domiciled persons, persons relocating to the UK that might have been overseas, or simply people like your presenters, who, unlike some of the people in the audience, are unfortunately UK domiciled and UK resident. That's QNAPs from a practical point of view.
But would we, guys, in considering, obviously we touched on sale to family members and to obviously settler interested trusts, or even to your own pension, and there any, Andy, for example, are there any other structures we should be considering which would be a quick and easy sale?
I mean, well, I think you're right to flag that we don't just have to gift assets at structure. We can sell them in as well. And I think at the basic level, the attraction of that is potentially you can create a loan account. So essentially, when I say loan account, apologies, you're selling the assets in at market value. You leave the consideration outstanding, and essentially the funds can be returned to the vendor without any further tax. You've obviously paid their capital gains tax by then, but there's no further tax. With that, as I mentioned previously, you've got to be careful about the transaction in securities rules. You also, and this is often forgotten that there is stamp duty on shares, and where there is consideration changing hands for those shares, then there's a 0.5% duty there. So the structures we talked about, you can sell them in as well as gift them. And I think I know John's had some experience of employee ownership trusts, but that might be quite an interesting route as well, particularly if we get past the budget and there has been a change, because there are there's essentially I call it a CGT exemption. That's not quite accurate, but you don't pay CGT going into the EOT. But John, what are your experiences on employee ownership trusts?
Yeah, well, extremely popular question from owner managers at the moment, employee ownership trusts, for the very reason Andy just stated. If they are structured correctly, there is no capital gains on the sale of the shares. So, I mean, the Finance Act in 2014 introduced them, so they've been around for a long time. But it's only over the last sort of couple of years that you've seen stuff in the press with the likes of Richer Sounds, and some quite substantial recruitment businesses have used them as well. So they're very much coming into the fore, and they also represent a way of basically bringing in the wider workforce into share ownership. But one of the sort of main commercial questions we always ask clients is, you shouldn't always do a transaction just because of the tax, because it's got to work for your business. And a quite simple question to ask yourself is, if you're looking at an EOT, is that, if your business is worth, say, 5 or 10 million today, and you transfer the shares into an employee benefit trust, which can be 51% to 100%, and then that business in 5 years' time is sold for 25 million, are you prepared not to share in that uplift? And that the initial reaction to that tells us, is an EOT correct for the current management team? But if you can get over that hurdle, they're relatively easy to set up. The consideration, which Andy can touch on, the shares in the company can be gifted to the trust, or there can be a real amount based on deferred consideration. Generally, what you see is anywhere up from 51% above is sold to the employee benefit trust, and you have a long period of deferred payment. So, for example, the usual way of valuing the business, you would say 8 to 10 times the profits of the business. And assuming the profit's pretty static, you can sell the shares to the employee benefit trust, and then the sellers can extract a total of 9 to 12 years of distributable profits on a tax-free basis. So it's very efficient selling your company or part of the company into an EOT. What you need to know as owner managers is it needs to work on the other side from an incentives point of view, because if you've got a management team that wanted to buy 100% of your business and are now left with a position whereby there's only 49% left and the rest is in EOT, that might not work for the current management team. But very, very popular at the moment. We've got quite a few on, and I suspect if CGT rates change in the budget, there'll be a lot more.
I think there's quite a pertinent question here from Michael Harris, in that he is asking, does he think that employer ownership trusts will be under threat as a result of CGT changes, or is it, I don't know whether anybody has a view on that at this particular point?
Well, I directly no, because again, you have to qualify for the release, and the restrictions are really very, very tight. I think the draftman certainly in terms of preventing any sort of skullduggery and monkey business did a very, very good job. But if you qualify, then essentially there is no CGT going in. So we're not, I suppose, at the mercy of a change in rates. I suppose the question then is, if they're going to cut back on entrepreneurs relief, they're going to increase the headline rate of capital gains tax, will they kick EOTs and the tax reliefs into touch? Again, it's speculation, but my view is is no. If you look at the very sort of clear reasons why EOTs and the relief were created, I think it was the Nuttall review in like 2011, 2012 or something like that, which made firm recommendations based on the sort of financial performance that the employee-owned companies provided. So I think the government was very much on board with that, and remains so, that giving employees skin in the game is, from a economic and social point of view, a good thing to be doing. So I would be surprised, but you never know. You never know.
Yeah. Okay, guys. Moving on. Again, Simon, we got any other structures? We've talked about QNAPs. We've talked about trusts, selling to trusts. We're selling to EOTs. Are we looking at any sort of personal company structures you would consider?
We've already discussed when you were just that modest few minutes away, the application of overseas family investment companies, and John, Andy, and myself explained the composition and structure of that. QNAPs, qualifying non-UK pension schemes, employee ownership trusts. And I was just going to ask John the question, does it really matter where the trustee is based, John? Should that be a UK trustee or an overseas trustee? Sovereign do both, by the way, but certain clients and practitioners do
Andy, from a tax perspective, it doesn't matter, does it, whether it's UK resident trustee?
No, absolutely not. And that perhaps is one thing in the legislation that might cause you to raise an eyebrow. There's no jurisdictional restriction on where the trustees are, and I suppose the attraction might be that if you can get the value into the trust without crystallising a capital gains tax, and the trustees are offshore, then potentially the gain there, in the first instance anyway, is not subject to capital gains tax. Now,
what you have to be careful of, though, Andy, is that the sellers in the business no longer control the business, and I guess that'll determine who the trustee is. Now, what an interesting point that owner managers don't tend to think about when they're selling to an EOT is actually the sellers, the vendors, can stay on the board and they can still drive the value of that business. So they don't step away from the business. They can still have a substantial influence. So that's something that certainly owner managers need to realise. It's not the end when you do an EOT. You can stay in and drive the value.
Absolutely. And there's one question from Lord Christopher Moore, Stuart, which came from my Teams chat about one solution is obviously not for all, but we are seeing an increased trend, especially if capital gains tax is to increase to the dizzy heights of the current high rate of income tax, God forbid. There'll be a significant number of persons that are able to just leave the UK, Stuart, and become non-UK resident and take advantage. We're not like American. We don't get taxed on our passport. We get taxed on where we live.
That was going to be one of my follow-up questions to the panel, actually, about the EOTs. But I mean, one of the things that occurred to me before we move on to that question was that basically, with all the changes going on in taxation, people have struggled through the pandemic, etc., etc. They may just say, "Do you know what? I've had enough. I want out before any changes in the budget, and therefore I'm going to liquidate my company." Are there, Andy, I'll ask you this question, are there any CGT consequences here for doing that, taking that option?
I'd like to think no, people haven't listened to this and given up on the world and then stuck their company into liquidation as a result. Well, just very quickly, I don't want to dwell on this, but usually it's relatively straightforward to receive a capital capital distribution on liquidation, and that, as one may gather, would be subject to capital gains tax and potentially entrepreneurs relief. But you do need to take care now, as you do with most things when it comes to the UK tax code, in that there are anti-avoidance rules, anti-phoenixing rules, that if you want to liquidate, crack open the company like a coconut and then start again doing pretty much the same thing, then there are rules which will catch that. And rather than having a nice capital distribution potentially subject to 10% tax, you'll find you'll swing all the way across to it being an income distribution at 38.1%. So not a good result at all.
All right. As was touched upon by Simon there, and also by Lord Christopher Moore, what about, let's leave the UK, let's head for some sunnier climes. Is this a potential part of the bag of tricks for CGT planning?
Well, I'll start with that, if I may, because dealing with the practical, in the last 2 weeks, I have actually received requests from European Union-based fund managers claiming they don't need to live in a particular local domestic high tax nation. What are the options? Which caused me to create a residency grid of the popular 15 nations. Now, I think there's over 30 nations in the world that have passed legislation specifically to attract retirees, inventors, entrepreneurs, young families to their shores. Legislation such as residency by investment and citizenship by investment. We have less demand for citizenship by investment, albeit a steady interest, but more to the point, residency by investment. And one doesn't have to go too far to, for example, the tropical islands or remote islands. In the EU, there is a vast number of countries competing for this market. Greece has reduced the worldwide income tax base for retirees to 7%. Italy have a non-dom regime where you just pay a fixed rate of tax of 100,000 euros, and you can actually remit your income into Italy and pay no further tax. Malta and Cyprus is popular, EU, English law, non-dom, with income and gains not remitted, not subject to tax. Portugal stole the show, certainly in the last couple of years, due to the historic synergy that Portugal has with the UK. And even with Brexit, there is passive residency programs, non-habitual residency programs, dividends not subject to tax from when you live in Portugal, providing you receive a dividend from a whitelisted company like the UK, Singapore, Malta. Then you go into the no tax jurisdictions of Bahamas, the UAE, typically Dubai, Bahrain, which tends to work if you set up a company in those jurisdictions, you're able to obtain residency. You have the source-based tax systems of Singapore and Hong Kong. Popular, yes, if your business is that part of the world and you like that environment. I particularly do. And unless you're sourcing income from those jurisdictions, you're not paying tax in those jurisdictions.
Okay.
Isle of Man, Gibraltar are low tax jurisdictions for residents and no tax jurisdictions for companies. So those are the 10 that are at the moment favourite. I've got a property grid, sorry, a residency grid of 15 nations, which I had to complete a study for 2 clients. One was involved with a major sale of PPE, and it's just right that they can be anywhere in the world and become non-UK resident, because their commissions will start to yield with contracts signed in the new fiscal year as opposed to the current fiscal year. So it is a growing trend, and residency and citizenship by investment should always be considered very carefully.
Thanks, Russ. Andy, can I steer that question to you now? I mean, about becoming non-resident. I mean, as Simon sort of listed out an extensive list there on opportunities, but what about, you know, becoming non-resident? Is this still a possibility?
I think it perhaps is worth rewinding, and that it is. Yeah, it is. It is. There is still some potential there. I think again, you kind of unless there are real sort of structural changes to CGT in terms of jurisdiction, etc., then it's something which is again isn't at the mercy of a change in rates, because the basic principle is that a non-UK person is not subject to UK capital gains. So there've always been some exceptions, and from April 2015 onwards, there's been a major exception, which is around UK real estate. So you have to be careful there. But I think today we're mainly talking in the context of sort of trading company shares rather than property. In terms of becoming non-resident, it used to be a real dog's dinner. Up until 2013, you were relying on a load of, I suppose, case law, piecemeal case law. From 2013, we've had a statutory residency test. It's not simple. It's not simple at all, but usually provides greater certainty in terms of really how many days somebody can visit the UK and not be deemed resident here. COVID, as a slight aside, COVID has really provided a bit of a fly in the ointment for many people. I'm not sure whether that's a pun or not, actually, but it has been a fly in the ointment because people have been stranded. Clients who have been stranded in the UK, or alternatively, I think you guys in Sovereign, you've obviously got a big presence in Hong Kong, but clients who have been stranded because Hong Kong won't let them back in. They came back home for Christmas, to the UK for Christmas, and haven't been able to leave. So that's been a problem, and continues to be a problem despite recent guidance last year from HMRC. But I suppose the real sort of simple play is that if I become non-resident on the 1st of April, I sell the shares in my company on the 6th of April and stay non-resident for the full tax year, then that, in the first instance, be outside of UK capital gains tax, so no tax payable at all. But there are two real key points there. The first is there are anti-avoidance rules, which if you came back to the UK within 5 years, that gain would resurrect itself and come and bite you on the backside again. The other point is what I always refer to as sort of frying pan syndrome, that you might escape a UK capital gains charge, but if you've gone and live in France, for instance, you'll probably pay an awful lot more tax on that gain. So going back to Simon's point, his sort of checklist of benign jurisdictions, there are lots of places you can go and you wouldn't have a problem there, but just be careful. Take some local advice as well.
I'm very conscious of the time, guys, and that it's quickly coming up to the full hour. I think at that particular point, I think we'll close off the presentation and move on quickly to the Q&A. But I think the takeaway from what you've heard today is that you've got a plan before triggering. And I think there's some questions in there've been questions coming in about, do we expect these changes to come in this budget or next budget? I think again, this is as was stated at the beginning by Andy, we are speculating somewhat, but again, even if there are no changes, you should be planning for in terms of CGT. You should have one eye on the future. Obviously, the budget is upcoming, but obviously, if you're very concerned about that, as was touched upon by the guys, that there are things you can do quickly, but obviously, I think that again, the real thing to take away from today is plan, and you will see on the contact sheet that you can contact any of us or all of us and ask these questions. So I think with that in mind, I think we've got a couple of questions that we'd like to touch on. One has come in from Ian Cuno. Unfortunately, he's already left, but he's saying he's asking a question whether he thinks that family investment companies have there's a shelf life for them, because obviously there's an increase in activity. I think I'd address that question to Andy. I think what's your view on that?
Yeah, I mean, this comes back, I think, doesn't it? So was it a Telegraph or a Financial Times article? I'm not sure. Beginning of last year. The time has flown by over the last 12 months. So it might be a bit a bit longer. I don't know, but there was an article, and I think basically what the article was saying was that HMRC had a unit which was looking at the use of family investment companies by wealthy individuals. Now, my view is that I really would have been surprised if that wasn't the case. It would be a bit of a dereliction of duty, I think, if HMRC weren't reviewing the use of family investment companies by high net worth individuals. So for me, it didn't really make a huge difference. But a family investment company, there's nothing mysterious about it. There's nothing, certainly doesn't have to be anything complex about it. It's a company that owns investments on behalf of the family. So at that level, I don't think there's anything particularly objectionable about it. I think once you start getting very complex and creating shares with artificial rights, I think you may have problems. Yeah. But I think the legislation's there already to sort of target that. I think just going back to the OTS review again, I think there was we do need to bear in mind, I think there was a relatively sort of oblique section to family investment companies there, which I think made the statement that if there is an increase in the rates of capital gains tax for individuals, then they will need to do something about family investment companies, because then that would create a real tax advantage. So, but there's a lot of ifs, buts, and pots and pans there. So, I don't know whether I've answered the question. I'm just rambling now. Put me out of my misery. Ask another question.
There is a future for family investment companies.
I think there was also we've touched upon on the potential on the various EIS schemes, for example. But Kirsty Greenwood has a specific question: could EIS investments be used with carryback for any upcoming changes? I think that's probably an Andy question again, is it not?
Yes.
Yeah. Well, I think it's a good question. I assume it. I assume that it probably can. For income tax relief, particularly, I think it's very clear you can carry it back 1 year, and I think if the legislation is, again, as long as the legislation isn't changed, if there are any increase in rates, I can't see why you wouldn't be able to take advantage of reinvestment relief, or sometimes called deferral relief, for capital gains tax purposes as well. I don't know whether that answers the question, but I think I wouldn't put it past the government, but I think there needs to be something specific which would stop you doing that.
Okay. Ladies and gentlemen, we've now completed the full hour, and I don't want to run over. One, I'd like to apologise once more for the technological problems that sort of interrupted the flow of the presentation. So apologies from my side on that. But in the meantime, as stated, within the slide now showing the contact details for the panel. And again, I'd like to thank the panel, so John, Andy, and Simon, for their contributions today. I'd like to thank you all for attending. There will be follow-up emails and Q&As. Questionnaires, to apologise, for you to review and complete and come back. And again, feel free to ask any and all of us any queries you might have, and we haven't had time to cover in the Q&A section. With that, again, thank you for your attending. I wish you all a pleasant day wherever you are in the world, and I look forward to seeing you next time we hold one of these webinars. Take care now.
Thank you for
attending.
Thanks, Stu. Thanks, guys. Thank you. Attendance. Thank you. Bye-bye.